My name's Sarah Laitung. I'm delighted to have a really excellent set of panellists here today with experts from the private sector who can tell us about their experiences in going from the scenarios that Jason's just told us about into how they assess and analyse their own climate risk in their own firms. A little bit about me. I'm in BEI's Corporate Finance Advisory. So we're a team of ex-private sector specialists who work with BEI's policymakers to input corporate finance expertise into policymaking. And most recently, I've been working with the International Green Finance team on how better data can help to scale up investment in climate resilience. So on the panel today, we've got, first of all, on my left, Ben Carr, who's Capital Risk Director at Aviva Group, so covering both the investment and the insurance side of Aviva. Then we have Murray Birt, a Senior ESG Analyst at Major Asset Manager DWS. Then we have Ellie Mulholland, who is Executive Director at Commonwealth Climate and Law Initiative. And finally, Xianfu Liu, Head of Analytics at Acclimatise. So why is understanding physical climate risk important for policymakers? Well, as we've just heard, climate change is going to have significant and varied impacts financially. And as the UK government, ensuring that UK businesses and financial institutions are able to assess and manage these risks is an important part of our green finance strategy. So if we're going to green finance, then players in both the private and public sector will need to have comprehensive and comparable data on the risks that they're facing. And so this afternoon, our panel is going to talk about how they're already starting to do that. So I'd like to kick off with a question for everyone, if I may. How do you think that understanding physical climate impacts is going to drive real behaviour change in the financial sector? And how has it impacted your firms or your client firms' corporate strategies? So Ben, would you like to start with that one?
Yeah, sure. First of all, thank you very much for the invitation. So we really appreciate dialogue with industry, government and climate scientists. We think it's really important that all of those bodies come together to try and resolve and think about how we can build tools and understanding together. So great that this event is happening. I think that Aviva's been, we consider being leading in this area for a number of years. So, for example, we were a member of the Task Force on Climate-related financial disclosures. Our Chief Responsible Investment Officer, Steve Wagood, was on that body, which is a voluntary set of recommendations around disclosing your risks and opportunities to climate-related issues. We were also a member of the European Union high-level expert group on sustainable finance, which made a number of recommendations around how the industry can respond to climate change as well as other sustainability issues. So this is something we really are very focused on, and we fully support all the initiatives that are going on, both in regulatory and at government levels. I think from an insurance perspective, we've always been thinking about the physical risks related to weather. So we clearly write insurance policies on houses, for example, and they're exposed to flood, windstorm, and other perils that can impact claims on our business. So we've been looking and using models that assess current weather and how it can impact our business for eons, along with all other direct insurers and reinsurers. So I think that one of the key challenges around climate change is not so much thinking about weather-related losses or physical issues. It's actually thinking beyond current weather conditions and starting to think about future climate scenarios and how our exposure might change in those new conditions. And it's about changing the tools that we currently have, which are very focused on today's climate, and seeing how we can recondition those to think about different scenarios going forward and use them to assess, for example, what a BAU 4-degree scenario might look like if emissions keep rising at current rates, or if we get our act together and even we hit 1.5 degrees in the Paris Agreement still, what might be the changes in physical conditions as a result of that? Because we recognise that will result in physical changes, even if we're only going up to 1.5 degrees. So that's, I think, been the key challenge. We've starting to build scenario analysis capability to do that. We've produced our 2018 climate-related financial disclosure. I've got a number of copies here, and if anybody's interested, happy to, first come, first serve. There's about 20 copies here that I'm happy to hand out, which sets out that analysis. And in order to build that scenario analysis capability, we've had to work with other insurers, organisational bodies, and academics. So in particular, we joined a United Nations pilot, both for investors. We've also joined an insurance pilot. And they've developed some tools with a fintech company called Carbon Delta that help us to assess the impact on our assets in different IPCC scenarios, so the 2.6 going up to the RCP8. So we've got 4 scenarios, and using these tools, it's starting to help us to understand how in those scenarios what impacts we might see on the asset side of our balance sheet, and in particular on corporates and equities, corporate bonds and equities. In order to make sure that we can look at the whole balance sheet and how that can impact, we've sort of built that out. So we've built out some capability to think about impact on sovereigns. We've also done some analysis using our existing catastrophe models to think about the impact on property and real estate, both on our insurance lines of business, but also on direct lines of business. And finally, we've also been looking at how we can recondition our models to think about flood, for example, in the UK, going forward in those different scenarios and not just under current conditions. I think the main conclusions from all of that analysis we've done to date, and clearly there are lots of limitations and assumptions, and one of the key things that we've had to do is, first of all, be very transparent about what we're doing. So, we try and explain very clearly what the assumptions are that we're using in those models. So we're not pretending they're right, we're not pretending there isn't uncertainty around those, but we think the key thing is to be transparent and then let people challenge them, or if they want to, hopefully over time we can improve them, refine them with input from others. But as long as you're being clear what you've done, then people can take the data and the analysis and the results and decide what they want to make best of them. The analysis from our perspective, I think the key conclusion that we have at the moment is that from societal and from a firm perspective, that the cost of inaction is far greater than the cost of taking action. So, the business as usual scenario where we see extreme increases in temperature and the physical impacts on our assets and investment returns is the most impactful on our business going forward, and probably presents the greatest threat to our business going forward. It also is the risk that we can't really hedge. So it's a systematic risk. There's no way we can position ourselves for that world. Conversely, if we look at a 1.5 degree world, there are significant impacts potentially for us. I mean, more coming through on the transition side, which we're not talking about today, but there definitely are from the potential disruption to the economy that could have big impacts for us, and particularly our investments in sort of carbon-intensive sectors. But this type of analysis helps us to, first of all, recognise that we need to be working with governments and others and promoting that we take action to end up and to meet the Paris Agreement, because inaction is not an option. But it also then, having made that decision, we need to think about how our strategy can be adapted so we position ourselves for the transition. So how can we make sure that we are going to benefit, ideally, from some of the opportunities that will arise, whether it be sort of new technologies in electric vehicles, renewable energy, or other technological developments like on the battery side or solar, etc. So it's really helping us to, first of all, understand where we need to be in terms of those different scenarios, what we need to be advocating for and working with other partners. And then secondly, it's helping us to think about where our hotspots are in those transition scenarios and how we can then make sure that we're positioned for the transition. And that is something that we can manage, so we can get the right side of the transition, we believe, if we think carefully. We've got the data and tools to mitigate those risks.
Thanks. Marie?
Great. Well, thank you very much for the invitation. And congratulations to the UK Government and the Green Finance Institute for running this event and for the strong focus on resilience at the UN Summit. So DWS is the new name for Deutsche Asset Management. We're majority owned by Deutsche Bank, but we're a separately listed company on the Frankfurt Stock Exchange. We have about 719 billion euros of assets under management. So we invest in equities, shares of companies, bonds of companies, both in actively managed funds where portfolio managers are choosing which stocks and bonds to buy, and also in passively managed funds. We own and lend to real estate assets. We own and lend to infrastructure assets, and we have a set of funds that lend money to and invest in different sustainable investments in emerging markets where they're trying to aim to get a social or an environmental benefit and a return on investments. So our focus on physical climate risk started a number of years ago when one of our major insurance asset clients asked us to start looking at the topic and developing some solutions for them. We're one of the larger insurance asset managers because they were seeing the risks appearing on their underwriting business and sort of knew that they would start to appear on, and were already starting to appear on their investments. And so in general terms, the investment sector's approach to climate change, so there's an investor agenda on climate change, follows sort of three different types of actions. So doing something with your investments, clearly, using your investor influence with companies, so engagement or stewardship activities, and also policy advocacy and working with governments to encourage the right framework. So within, and we've been looking and taking these types of actions for many years. We were one of the first major asset managers to identify that climate was a mega trend for the asset management industry in 2005, and have tried to really advocate and support action on climate change. We even had a carbon counter in Times Square for a number of years. But so our approach to physical risk within investment is about tilting or shifting a portfolio to reduce your exposure to companies that are exposed to physical risk. And there are a number of data companies that are out there. Ben mentioned one, but there's a few others that are developing data to analyze to find the location of companies' factories and facilities and operations, and then plug those locations into physical climate risk models. And that gives a pretty good under analysis of which companies might be more or less exposed to physical climate risks. Of course, the best assessment of physical climate risks are probably the companies themselves, and that's why engagement or disclosure from companies is so important as well. And then also trying to make some positive investments and looking at what can be done. So some of my colleagues are looking at particular commercial buildings that we own in very high-risk areas and what could be done to help protect them from flooding, for instance. But also in sort of what positive investments could be made. So we have a 20-year track record in microfinance, which is lending money to microfinance institutions that then lend to small entrepreneurs and businesses in developing countries. And I wrote a paper earlier this year which sort of suggested how there could be greater synergies between microfinance and microinsurance. On engagement, most investors have been focusing just on encouraging companies to reduce their emissions, and more needs to be done there clearly, and working through the Climate Action 100+ initiative that we're a member of. But I'll shortly be publishing sort of the start of a discussion paper for the investment sector on what investor expectations could be for companies on physical climate risk. So both on the disclosure side, and I was honored to be asked to chair a working group on how the TCFD that Ben mentioned could be extended to include greater focus on physical risk. And so that was an initiative supported by the BRD and the Global Center on Adaptation, and that's available on physicalclimaterisk.com. And so that's a really great starting point of suggestions of how companies should measure and disclose and manage their physical risks. And we need to see more of this, but also not just disclosing risks, but managing and reducing risks, because, for instance, extreme heat could knock off $2.5 trillion off of global GDP by 2030, and that has very strong equity impacts on people in agriculture or construction or outdoor workers in developing countries. So there needs to be more focus there. And then finally, on sort of the advocacy policy side of things, UNEP-FI brought together a group of financial institutions to write a background paper with the support of Acclimatise and a few other organizations as an input paper to the Global Commission on Adaptation, which you heard about this morning from Emma Howard-Boyd. And that paper is available on the UNEP-FI's website, and it's a sort of set of recommendations on how we think physical risks should be incorporated into the financial sector, both in terms of the prudential and regulatory interventions, such as stress testing, what the Bank of England is pioneering, towards adopting greater risk, climate risk management tools and standards. So a whole range of recommendations that really need to be taken up by all sorts of organizations which in some way influence or shape or set rules for the financial sector. So that's a really, I think, a very good sort of cookbook almost for the policies that we need to put in place to encourage more financial institutions of all types to better assess, manage, and ultimately contribute to the reduction of physical climate risks.
Thank you. Ellie?
Thanks, Sarah, and thanks to the UK government, BEIS, and the Green Finance Institute for the invitation. I hope my Australian accent doesn't prevent me from saying something meaningful about climate change.
Well, my Canadian accent didn't either.
So I take a slightly different tack because I'm here from the Commonwealth Climate and Law Initiative, so we're a non-profit. And so with developments in our scientific understanding around the physical impacts of climate change, such as those that Jason and Emily Shukwa spoke about this morning, that really means that climate change has moved beyond an ethical or an environmental issue to become a core financial and strategic issue. And so that's really where the CCLI was born. So we're a radical collaboration between academia, so the University of Oxford and others, environmental law charities like Client Earth, sustainable finance charities like His Royal Highness's Accounting for Sustainability, and also some big bad money-grubbing corporate lawyers like Mintrellison. And so we do legal research and stakeholder engagement, and we look at what does this evolution of climate change to being a financial and strategic issue, what does that mean under existing companies and securities laws, particularly directors' duties and pension fund trustees? And so the answer is it is a core governance and disclosure issue like any other. And so our theory of change really is that we can drive transformational behavioural change within corporates and funds by pointing out this risk of litigation and liability to the only individuals that can really be sued when you pierce the corporate veil. And so the message really is about appropriately assess, manage and disclose climate risks and opportunities now, or you could be sued in future. Having a little think about some of the benefits and, firstly, the barriers and benefits of disclosure of climate-related risks, because one of the things really is that it's such a scary story and there is so much concern around disclosure of downside risks. And so a few months after the TCFD recommendations came out it was June 2017, so a few months after that, the CCLI published some legal research which was responding to concerns amongst corporates and the director community that disclosures in line with the TCFD recommendations would open them up to liability. And that legal analysis finds that actually non-disclosure is more likely to result in liability so long as the TCFD disclosures are not misleading and not inconsistent with the rest of your disclosures, and that's just proper disclosure, robust disclosure practice. So long as that's the case, then that will actually protect you because disclosure is an investor lens. And we have is this material to investors? Well, we now have 120 trillion assets under management that are supporting the TCFD. So they say it matters to them. And then we have the Climate Action 100, which is Murray's just mentioned before. So they have 30 trillion assets under management. And they say, yes, it's very important, this information. And so actually the barriers, this concern that has been cited actually isn't a legal barrier. Thinking about the benefits, though, I have 3 points to say on that. The first one is benefits become a bit moot if it is a legal obligation. And under any securities law regime, if you're any kind of listed entity, you have to disclose material issues, material risks to your performance, position and prospects. And so benefits really becomes moot if you have to do it. And we know that climate change foreseeably is a financial risk issue. So it could be something that you need to disclose under mandatory securities regimes. The second thing about benefits is that it's an opportunity to tell a positive story. So the climate science is getting really scary, but the physical risks differ across geographies, and we normally, my understanding of investment is that often you're thinking about investment according to asset classes or industries or sectors, but they can have very different physical risk exposures. So if you have the positive story to tell, then it's an opportunity to do so, but also it matters to your investors and they want to know that positive story. So it's material information. So it's best to do the assessment now, find out you're less exposed and tell that story, or find out your vulnerabilities and then implement the right control, risk management, enterprise risk management and controls to mitigate the risks. Because as Murray said, it's not really just about, it's disclosures which drive risk management and strategic resilience to these climate vulnerabilities. And then the third thing around the benefits of disclosure is because if you aren't one of the first movers and now the followers that are really catching up and disclosing, Aviva is very much a first mover, but we've got the TCFD status report that came out in June shows that people are very much catching up. And if you're not on that journey, then your story will be taken away from you. So some of the developments in data and technology mean that we've kind of seeing this idea around hostile analytics, that information asymmetry that we expect between insiders within entities and then the outsiders actually can turn on its head. And because the physical risks can be apparent, so you can do that assessment without having that inside information. So the benefits of disclosure are really around getting in front of the 8 ball. Otherwise, your story will be taken away from you. I might leave it there for now.
Thank you. Xianfu?
Thank you, Sarah. Thank you also to the department, BASE and Green Finance Institute for the invitation. And just a couple of words also about Acclimatise. So it is probably the largest pure-play adaptation climate resilience consultancy there is in terms of the number of people we have working exclusively on adaptation and resilience. And also our history, 15 years is a very long time, I think, in this space. And we do advisory services, and we also have analytics tools all around physical risks. I think I'm going to stick very strictly to the questions Sarah posed, actually, what has been, the changes driven by the emerging trend. So as a consultancy firm, we saw 2 major shifts, actually, in recent years. The first one is there's a drastic increase in the interest of our services, which is great news, naturally, to us. So a lot of non-usual suspects. Actually, we have been working for quite a long time with governments, with multilateral development banks. And in the past couple of years, since the publication of the TCFD recommendations, we are getting a lot of interest from the financial institutions and the financial services sector. So that's a major change we've been experiencing. And the second one is, for the people we work with from the financial services sector, financial institutions, and we also saw the responsibility of assessing and managing climate-related risks, moving from the typical sustainability investment or the ESG teams towards more sort of the central engine room of those institutions to credit risk teams to actual deal investment teams. Sometimes it's more corporate strategy teams. So this is getting just putting the issue much higher on the agenda of those organizations. And in terms of what we do with these observed shifts and changes, so as a consultancy firm, we need to, of course, respond to the needs of our clients, and we carry on doing our consultancy services, but more importantly, we are really gearing up to provide more scalable analytics tools to respond to the needs of the market. And how do we do that? I think we heard quite a lot in the morning about the TCFD disclosure, the information currently being made available on voluntary basis is not exactly fit for purpose yet. And part of the reason is that, the information is not the speaker from PRA also said, the part of the reason is not mandatory yet is because, we simply don't have some of the information really required to do a very sort of robust, solid disclosure. And the information is not, of course, information from the institutions themselves, the assets they are managing is one thing, and the other part is, of course, the climate hazard information. So Professor Lowe provided a presentation. There are some gaps still quite critical knowledge gaps we still need to address. So we wanted to take a little bit of time, maybe while we work with our clients, trying to figure out what exactly is the right amount of information to certify the needs of the regulations, and also to more critically to really make sure the information is helpful for decision making for organizations. Otherwise, doing it for the sake of doing it is not going to get us very far. So we want to take a little bit of time working with our existing clients to really figure out, what kind of information will be really decision relevant and useful. And in the meantime, we also wanting to work with major international initiatives, to, for example, the network of the green financial systems. They are in the process of developing a handbook on, how to disclose and assess physical and transition risks. So we want to work with these international initiatives to really contribute and provide inputs to develop the guidance, some of the technical standards, so that over a period of time we have some kind of commonly accepted benchmarks so that we can work with. Otherwise, the information will be too diverse and not exactly comparable amongst each other, and therefore not particularly helpful. And so just touch upon one point about the way we're going to develop the analytics tools is that we of course value and very much see the point of producing very neat and clear conclusions and the numbers. For example, one question raised earlier to Jason's presentation was, there's no uncertainty. I give you a number, temperature increase 2 degrees, we're going to see 5% decrease in your revenue. So that kind of information not necessarily helpful. I think we want to also there are different levels of analysis it's required depending on the purpose. And so we want to have a much thorough understanding of, what exactly is the information analysis is supposed to serve. And we produce those high-level analysis, risk mapping, but also look much more closely at each organization, produce narratives as well, so that they can have internal dialogue amongst the different parts of the organization, so that they are fully in control of the information they are provided. So
Right.
that's...
Thank you so much. And to your point about the information and data that's available not being sufficiently consistent for investors to adapt to and take into account when making investment decisions, I'd really like to ask Ben, given all of the work that Aviva has done on the TCFD report, and perhaps Xianfu, you could chime in as well on your client's experience. What sort of data did you use when you were producing your TCFD disclosure? To what extent was it sort of more of a bottom-up or a top-down kind of approach? And your access to that data, and what kind of challenges you experienced in being able to get the data that you needed in order to produce this analysis?
Okay. So I think, as I say, on the insurance side, we'll have very granular data around, for example, we're insuring a property, where that property is, so we know the location of that property, and therefore, if we have some assessment of the different perils in different climate scenarios, then we can start to assess the risk in those different scenarios. So I think in that context, the challenge is very much getting access to, climate conditioned event sets. So at the moment we have event sets in our catastrophe models that are based on current weather conditions, and actually turning those into an event set that's looking at a different climate environment. It's actually quite difficult to get that type of analysis and to use that in our catastrophe models at the moment. So that's where we need to go and find other data providers. We need to work with some of the climate modelling and some to try and build out and try and recondition those models. So that's the challenge on the insurance side. On the asset side, the challenge is sort of more fundamental, which is that traditionally we haven't been collecting location information for the companies that we are investing in. So we don't know where their factories are. We don't know what supply chain vulnerabilities they may have. We are investing very much based on historic performance of the stocks, the sector, traditional measures of risk. Maybe looking at their financial reports, but not really looking at that physical element to their footprint and their profile. So that's where we've been using Carbon Delta and others, and as Ari says, there are other providers out there, so certainly not the only one at all. And they are basically doing sort of big data searches, going out there and finding out information about the locations of companies, factories, distribution centres, retail locations, whatever it may be, trying to understand their supply chains in order that they can then use that information to overlay different climate scenarios, different perils, to understand the potential risks from physical climate change. So that's a big new element for us, and that's something where at the moment we're tending to work with third parties and external providers, but I think over time that's an area where we'd want more information. Potentially that's something that disclosures could help with as well, in terms of companies actually being much more transparent, some of the disclosures around where their locations are, what their vulnerabilities are, and that would really help, I think, to really sort of build this out, ensure we've got comparable assessments and we've got the data we need to do the analysis.
Mm-hmm. So from our side, we work with quite a number of categories of data, actually. So obviously, climate hazard data is a core part. I would say there were two broad categories. One is the off-the-shelf. So we can have, climate data, great climate modeling centers like the Hartley Center and so on. They provide these projections in a fixed sort of number of years of cycle tied to the IPCC assessment reports. And we also use long climatic environmental information, sometimes not necessarily provided by climate models like landslides and wildfires and this sort of processed data, but they are nevertheless still off the shelf. But when it comes to working with financial institutions, we need a lot more information than this, environmental information. So the like Ben mentioned, the asset locations and the characteristics of different assets, what kind of material they're built, and so on. And also increasingly, we also want to have information on the organization's financials. So if we want to assess the financial impacts, financial implications of physical risks, so those were sort of off-the-shelf information, but I think quite importantly, we realized, clients don't always like the black box approach to analysis. So they also quite value our sort of tacit knowledge in a way that we worked for many years in different sectors, in different geographies, which enabled us to build over 15 years, the sort of in-depth knowledge about the sensitivity of different sectors, subsectors, different assets, the sensitivities to different types of climate variables, and also the sort of threshold. Different structures, different types of assets, they will have quite a different tolerance level to changes. So we normally think about extreme weather events, severe floods and hurricanes, probably very damaging. But in fact, if we look at, for example, oil and gas industry, look at the facilities, and what our analysis showed, actually, if you look at very incremental changes, temperature increase, and they calculated over a period of, say, 10 years, the kind of incremental changes caused related efficiency reduction in the system, and then translate that into revenue loss. It's actually much more severe than the sort of one-off extreme weather events. So this kind of very contextual and sector-specific information and the knowledge and the analytical approach is also very important. So we try to use that, the sort of knowledge and expertise built up over the years to best use when we work with clients, particularly look deep, the deep dive analysis.
Great, thanks. I will open up to the floor for questions in just a moment, but maybe I'll take this opportunity to ask one more question to the panel. As a room full of public sector officials who want to encourage as much disclosure as possible, I thought it was interesting, Ellie, what you were describing about the barriers and the benefits to doing disclosure of your climate risk. And I was wondering if anyone on the panel wanted to comment on what Ellie described around the benefits and the barriers, and in particular your point about basically not disclosing is a big risk and liability in and of itself. Has anyone sort of had experience of those factors?
Well, I think as investors, we want companies to be disclosing more, both on their vulnerability to transition risks, but also on physical risks. So there haven't yet been any, to my knowledge, any sort of shareholder resolutions on physical risk, but I think those will be coming, and they are sort of asking in general for companies to disclose their climate risks. So that does sort of group in physical risks, but perhaps not explicitly calling it out. I could be incorrect on that, but we have strongly voted in favor of those types of resolutions in the past, and will continue to do so. And more investors are also voting in favor, but still some aren't. And in a way, that's a bit of greenwashing if they have sort of ESG or climate funds and they aren't voting in favor of climate resolutions and similar sort of resolutions. So yeah, I think it's great to have that legal analysis, because sometimes that is a message that's sort of seen from some perhaps more U.S. companies. But we have investors want the disclosure. Regulators are starting to talk about mandatory disclosure, and we have sort of the cookbook, if you like, of ideas from the financial sector on what types of disclosures on physical risk would be useful, both on the company's locations, where their revenue is coming from, what's the extent of their insurance coverage, what are some of the, what are buildings made up of, what are their supply chain measures, where do they see their risks? Because those are sort of issues and assessments that you can't really make from the outside, even with the best assessments. So,
Thanks.
Yeah, maybe I can share just some very personal and concrete experience actually in terms of taking action and do the sort of unconventional things. So before I joined Acclimatise, I was with the Asian Development Bank for a while, and over there I was tasked to put together this climate risk management system throughout the whole business process. And I was pretty daunted, so I started to talk to some loan officers, and I said, this is what you do, and I said, I'm in charge of this adaptation here. So after a bit, if they are, polite, they will say, tell me what you do in detail. Otherwise, people in the rush, they say, get lost, I'm not interested. But I think so you work very, very slowly and patiently with people you identify as potentially your friend. So I tried to encourage them to think about the bank has a lot of infrastructure investment in Asia Pacific with those huge mega cities popping up all over the place. So they do lots of investment in transport and energy. So I work with them to really think through why climate change is a problem for them. So there was, a big project in Nepal, or, very, very torrential rain came, and the very, very precious investment made on this highway, got damaged, pretty much unusable after one torrential rain. So these kind of things, you point out them, say that, this could be averted if you had thought about, the increase in rainfall intensity in the design of your drainage, for example. So then I started to work with the engineering design team on those long projects and trying to point out where the entry points could be, when you do your engineering design. And gradually they came around and they say, okay, tell me more, what exactly I need to do. And so after that, they, for them, they have very tight timeline to process the projects. If you wanted to introduce more things for them to do, the initial response will naturally be no. But then if you try to provide a solution and not slow them down, and then instead they saying, I help you design the project, which is, shows innovation, shows, forward local insights. And the board actually very, very much impressed, and then the project got a green light in no time. So gradually people started to see the benefits of doing things slightly differently. So this is, I think, more about incentivize, and there's very fortunate situation. The board and the president himself was so very interested and wanted to see this, making progress. And I think by punishing and nagging people will probably only get you so far, but not going to be sufficient. So incentivizing and really showcasing the benefits of doing things differently.
Yeah, thank you. We've got about 10 minutes left because we started slightly late. So at this point, I'd like to open it up to the floor. Does anyone have any questions for our panellists? There's one at the back.
Hi, I have more of a background in private sector and a bit of a reporting background. And what I find really interesting about talking about disclosure is it's very easy to assume you don't get all the right answers from whatever information you get, as you mentioned. I was wondering if there's any kind of concrete examples or illustrations of maybe areas where you felt that disclosure requirements maybe from TCFD have maybe not necessarily captured what's required, and sort of a discussion on, like what's the right balance for disclosure, because you need to kind of hit the right kind of trade-off between giving the information that you want without having such a rigid framework that it can be manipulated.
Great, thanks. So examples of TCFD's disclosure that's not so helpful. And should we take another one at the same time?
Yeah, thanks. It's a follow-up question to, I think, a comment that was made maybe by Xianfu with respect to commonality across TCFD reporting. And I'm thinking specifically, if I'm a fund manager, I can pick up a set of reporting accounts and look at cash flows and debt equity and earnings across all sectors. So I can look at banks, I can look at oil companies, I can look at food companies and compare and contrast. However, I don't think it's quite maybe the case so far for TCFD. I just wonder if the panel could give us a view on when they think we might move towards a more common approach to TCFD reporting so that we can actually do comparisons across sectors. Great,
thanks. So how do we get data and metrics that are comparable across different sectors of the economy? Are there any volunteers for those two questions?
Yeah, I can make a quick start. I think the analysis would be built on a few very basic building blocks. I think one of the things is the underlying climate scenarios you use to carry out those analyses. Your risk analysis based on what? Based on different underlying scenarios for your sensitive climate variables. So I think, we can identify maybe a few very high level the areas where we could have, a sort of common data sets at least. The trouble now is just currently there's absolutely no, common basis to compare results. So I think a common scenarios will be a good starting point. Mm-hmm. And also the time, the time horizon is another big issue. So obviously this will depend very much on the asset and on the sector you are dealing with.
I'll just jump in. Actually, I've one kind of theme to discuss on both questions. So where the TCFD doesn't really capture what's required, I think what isn't helpful is what we're seeing at the moment, which is a lack of the financial implications. We're starting to see TCFD disclosures under the recommendations, but doing that step around financial information implications. And what will be really crucial to making that helpful is connecting the front and back end of the annual report. So talking these narrative disclosures that are the TCFD disclosures with what's happening in the financial statements, because that's there are forward-looking assumptions in your position and your performance. And so something that's come out of Australia, I'm not just giving a plug because I'm Australian, it really is world leading. So it's some guidance from the Australian accounting and audit standard setters on materiality estimates. So materiality and accounting estimates, and so climate risk guidance for that, which says that investors care about this, they're telling you they care about this in the decision making. So even if climate risk doesn't affect the numbers in your financial statements, you might need to disclose that in the notes to the financial statements. So what's not so helpful is not seeing the financial implications. So I think what will be helpful is connecting the front and back end of the report. Yes, Australian uses IFRS financial, the international standards, and it has been commented on by the chair of the IASB at a conference in Cambridge earlier this year. And I think that the commonality across TCFD reporting, we already have commonality with the accounting standards, so that could help to drive that.
Yeah, I'd say we need commonality as soon as possible. And so if we are in a climate emergency, which I think we are, we need to be moving on that. So I hope we can get there in 2 to 3 years at least. I agree that we need to be connecting on the financials. And where TCFD was largely silent and didn't provide as much guidance was on physical climate risk, and that's why the European Bank for Reconstruction and Development and the Global Center on Adaptation brought together financial institutions to recommend to try to extend and expand the TCFD on physical risk. And Acclimatise was one of the authors of that, and we. So one of the main recommendations we made is that we should be taking insurance metrics and applying them to corporates. So insurance companies are regulated and have to disclose and manage their annual 1 in 120, 1 in 100, 1 in 200 year value at risk from physical climate risks on their underwriting, on their insurance contracts. that sort of methodology, as long as also the climate underlying models become climate conditioned, could be applied and used by corporates. And that should be sort of the vision and the aim to be, and the point where companies are disclosing their value at risk, financial value at risk from physical climate risk in different scenarios on different time frames. And that would provide some commonality. It'll take some time, because if you ask a company to apply insurance models, they would look at you quite puzzled. But that is, I think, what investors will be asking, because I'm going to suggest it, and that will be. But that's sort of the end goal, I guess, in a way. And there are a lot of types of disclosures that companies can be making to improve their comparability and to improve the information that then goes into these financial climate risk models that are starting to emerge and develop.
Could you maybe give us a feel for what that would actually look like?
In terms of?
So what kind of metrics would come out of performing that?
So it would be, so what is, if you're a company and you've got all these facilities around the world, what is the value, your financial value at risk, your VAR, from a 1 in a 20 year or 1 in a 100 year extreme weather event hitting some or all of those facilities? Because that's what insurance companies have to do as part of their, you can say that. So,
yeah. Definitely. So, I mean, I would totally concur with everything that's been said, and certainly as part of the scenario analysis work we're doing, we're trying to bring some of that insurance discipline to the climate analysis. And I think definitely if we were seeing more of that in the TCFD disclosures, then that would be really helpful, and particularly if it was relatively comparable and consistent. So, I mean, the only other thing I'd say that we need to move quickly, absolutely, we need to be really fast, but we probably also need to recognise that right now there are things, very basic things, that aren't happening in the disclosure space that have to happen before we can get to answer these core questions. So not enough people are disclosing TCFD, they're not providing TCFD disclosures, so we just don't have enough coverage, and a lot of disclosures are relatively partial. A lot of people aren't currently doing scenario analysis at all, and we need to get sector comparability before we get cross-sector comparability. And again, there are a number of initiatives looking at building sector comparability, but again, it's not there yet. So there's a lot to do. We need to move really quickly, and I think we just all need to work together and put pressure on companies to get there as fast as possible, so we can start to really use the analysis well.
Exactly. Even a simple metric like where your revenue comes from. Like some companies say, okay, 20% of my revenue comes from the UK. Fine. 80% from rest of the world. Great. I can't really break that down to say, okay, maybe, or which facilities are more important to you, and they might say, oh, that's very proprietary, but at one point, like income accounts and income statements from companies were considered to be proprietary, but we'll get down to much more granularity of information, but companies will be somewhat resistant, but that's the debate, and we'll find a middle ground. But providing some more granularity on some basic factors is a good starting point.
Thanks. Any more questions? Last chance. Nope. Okay. In that case, we can wrap up, and I'll maybe just ask a very, very quick final question to each of our panelists. What is the one key message that policymakers should take away from this session?
I'd say that the tools and the recommendations are increasingly available. So on disclosure, on what the financial sector need and could do, the tools, the data analysis tools are starting to be there. We can start to act, like we need to be acting, and so I don't, like many of the resources here, and we can probably from the panelists put together a list of different resources that you can draw on. It's all there. We need to expand and do things in the UK, but also increasingly in emerging markets, and so we need to help take all these tools and messages and just get more action going.
Yeah, I would say we may not have all the answers, from the climate science side. We don't know everything about a tipping point. We don't know much about this decadal predictions, but we, ideally we want to have all the answers we have, but we don't. The reality is that we do know a lot. And there are a lot of sufficiently robust, pieces of information available. Jason presented. We say we know, under all scenarios, certain things are going to happen. So we should make the most of what we know best and get going.
Thanks.
So policymakers have public interest duties, and I just want to quickly reflect on how they are shifting, because I've heard the Paris Agreement called the mother of all market signals, but I think that it's also, the Paris Agreement goals are the biggest indicator of your public interest duties in 2019. And so I think it's really about connecting data and disclosure and climate and ecological breakdown to your roles and your mandates and your responsibilities and your opportunities. So just call to action on that, please.
Thanks.
I think the first thing I'd say is that, when we're doing the analysis, everything's pointing to the fact we're not currently on a path to hit the Paris Agreement. So I think that's, the more that policymakers can do to help get us on that right path and encourage the right behaviours, both for the private and the public sector, is absolutely key. And then secondly, I think I'd just echo the points around disclosure. There are no excuses for not disclosing anymore. There are tools available. Clearly there's uncertainty around it, but you can explain that. And everybody should be doing their best to get disclosing and to help people to understand these risks and to help us all to sort of build solutions to this and get the financial flows moving in the right direction.
Great, thanks. That's a really good positive message to finish on. And so last thing, just to thank all of you so much for coming and talking to us and sharing your experiences with us on disclosing physical climate risk. And so, yeah, thank you very much.